All right, what's going on, everybody? What a week, huh? It's wild. Let me just make sure everything is doing what it's supposed to do. Looks like it is. We're running on YouTube and we're in the Discord. All's well that ends well. All right. So we did have a topic request today about trading view scans. It's actually, we're going to cover this one tomorrow because the person who requested it said they would be here tomorrow. So, scans are something we're going to get into tomorrow. This and it's for TradingView, but when it comes to scans, it's more about using the app than anything else. The criteria, I don't know if we've kind of gone through this before, but probably shouldn't have uh, some universal watch list or universal scanner that would fit everybody's needs because I can tell you right now, people trade so much trash that I would never trade. So their watch list or their scanner wouldn't do me any good. I'm very picky about what I consider liquid stuff. So I would only trade things that meet my needs. When it comes to running a scanner, some people focus on the process of elimination. They want a very small list that doesn't have a lot of things in it. But sometimes the purpose is the other way around, and we're trying to find as many things that meet our criteria as we can. So it's not right or wrong. It's more about what is it I'm trying to do, right? ADR for me is average daily range, ADR. So if you're searching around on the net and it's somebody else talking, you'll have to ask them. But for me, ADR. I came up with ADR because ATR, average true range, uses a math that I can't duplicate. So if you go to ATR, average true range, that's kind of the industry standard that a lot of traders will use. I don't like it. I can't duplicate that math. So since I can code my own stuff, I wanted something that had math that I could duplicate, that I could replicate on multiple devices. And I decided to build my own average daily range. I use a 1 month average daily range, ADR. So 21 days, depending on the broker you use, you could get away with 20 days. The 21st is just for the lag math. It's just the math process, right? So it's basically 20 days. I set it at 21. And the idea behind using that ADR is to ask a very simple question. What's the average movement of this thing, stock, options, because we could put it on anything we want. How much does this thing move on a day-to-day basis? Every single thing out there has an average daily range. So if we think about percent change in a day, a 3% move or a 5% move in Tesla, that's just another day at the office, right? A Tesla 5% move, no one even blinks. They're just like, yeah, whatever. It's just a normal day. If SPY moved 5 or 7% in a single day, oh boy, we'd be talking about it for a long time. And it has done that before and it will do it again, but it doesn't happen very often and it's a really big move. So we can't use just some off the shoulder, off the cuff answer like, oh, 5%, 3%. What's the average move for whatever it is that I'm looking at? I really want to know that answer. So I built the ADR to give me that answer. Once I know the answer, I know how far does this particular stock move on an average daily basis. For SPY right now, that's $7.50 or 7.75. It's around 1.14% on a day. And I can take that and look at, well, what are we doing today? Nothing. We haven't done anything today. But we can gauge what we have done today versus what the average daily range is to be able to ask questions like, is this thing behaving normally or is it doing something outside of the norm? There's a couple of reasons we want to know what the norm is. Technical analysis is looking back at the past at what price has normally done to have a feel for what it might do in the future. If it's misbehaving and doing things that aren't normal, the ability for technical analysis to accurately anticipate what's going to happen next goes down a lot. So if it's misbehaving, our analysis will be less accurate. Our chances of success are down. It's going to decrease. And I may want to change the strategy that I'm going to use, knowing that it's misbehaving and that the accuracy is going to decline. So, average daily range. Now, of course, it also draws lines on the chart, and we can use those to see has it gone, far enough one way or far enough another. Once it gets there, we can start asking questions like, well, what is it supposed to do once it gets there? I used this indicator for years where I only had today and I could not see in the past. That really sucked because I had a hard time explaining to people how valuable this thing was when you could only see it on a day-to-day basis, like how it interacted with the ADR last night. That held as support. And where are we going? To the other ADR. I called that at 7:30 this morning, by the way, that hey, we were on one side and we got a history of going to the other side by the end of the day if we get to one side early enough. So this isn't even a surprise that we're going up there because I called that out, oh, I don't know, 5.5 hours ago, something like that. There you go. Cheers. But how do we know that that's what it does? Well, if you can only see it once a day and you can't see what happened in the past, it really sucks. This year, however, got the new ADR, which is doing a lot better than the old ADR because the new one allows us to look back at previous days so that we get a feel for what does happen when price gets to the edge. And this isn't just an ADR answer either, by the way. If you want to get a feel for pivot points, whether it's a floor pivot, uh, Camarilla pivots, ADR lines, volume profile, go in the past and see what price has done before at those levels. And then you get a much better feel for what we should anticipate going forward, right? It's back to that technical analysis question of, well, what's it normally do when it gets to those levels? So after using this ADR indicator for a couple of years, I've gotten pretty comfortable with what price should do when it gets there. And if it doesn't do that, it doesn't mean that, oh, it's broken, it doesn't work, this stupid thing is no good. It just means that, hey, we're doing something we don't normally do. We're above and beyond the norm, and we're now seeing, quote, unusual price action. So it's a nice tell, and it gives us our range for the day because everything has a range on it. It would be really cool if we had this circle, right? Let's see if I can do it. Say we had this ellipse or this circle around price as it moved. And all day, every day, it was just showing that circle of how far it could move on whatever time frame you're on or on a higher time frame. That would be great. If we had that, we would see this sort of channel between the two red lines just following price all day long. You know what it would look like? It would look a lot like Keltner channels, oddly enough, right? So if we was to take the ADR off and put Keltner channels on, that's going to look very much like an average daily range doing the exact same thing, right? Except that this Keltner channel is based on the time frame that we're on. It's not based on the daily range. So we need a daily Keltner channel, something that can look and use the daily math and apply it to the intraday, which I happen to have one of those. It's just it's not installed. It's on the Thinkorswim workbook. If you search for it, look for something that says spiders, because Trend Spider back in the day, not even back in the day, they still do that. Trend Spider has tools that can look at the daily and put that tool on the intraday. So that's when I built the Thinkorswim, I did the same thing. I called them Trend Spider Keltners or Trend Spider moving averages, Trend Spider Bollinger Bands. It's Bollinger Bands, Keltner channels, all of those would be considered the market's average movement to fit that time frame. Whether it's a 1 standard deviation or a 2 would define whether or not we should be hitting it on a day-to-day basis or a weekly basis or whatever. But it's still just a reflection of how far should this market move before it has moved too far, and we have to consider it maybe mean reverting or doing out something outside the norm. So we'll put this down to a single chart. Let's go over to SPY. We'll use multiple time frame analysis, and we'll put on some indicators. We've already got the MACDs. We'll knock that off, and we'll add Kelts. Multiple time frame Keltner channels. Oh, that must have been something proprietary. It let me use it, but it's not normal. So we may get something that I wasn't anticipating. Now we got to set it. We can turn these off. They don't match what we're talking about. Turn that off. All my anchored VWAPs, order blocks. Okay, we got the daily, and that should be what we need. There we go. Yeah, that's a little big, but it gets the point across. There's the midpoint of the daily Keltner and the high side of the daily and the low side of the daily. It's a little big, but you get the idea, right? That every market has a range, and we want to know where that range edge is. There's the high side, there's the low side, there's the midpoint. Price just staying inside that average daily range. I'm just picking on the Keltner. It could have been VWAP bands, Bollinger bands. It can be anything, right? Doesn't matter. So average daily range. I have found it to be very valuable over the years, and the more I use it, the more I like it. I'm not looking for these perfect examples of rejection, by the way. I mean, if we get it, that's fine, but that never really was the goal. The goal was to just try to define how far have we moved today? How far should we move today? And if we continue moving in that direction, how much farther can we go before we've reached the average daily move? All right. So that's ADR. If you want to stay with the industry standard, you could use ATR. average true range. There's absolutely nothing wrong with the average true range, by the way. It's just I want to use something that I understand better. And if you've ever seen the math for the average true range, it's a head scratcher. Stockcharts.com has an indicator school or chart school, is what they call it. And so you can look up really just about any topic you'd want. We'll just search ATR. So here's ATR. It gets into volatility, position sizing. We want to get into, there it is, the math behind it. Sure, we'll take some cookies. We like cookies. So here's the math behind it. It's got a nice little write up about all the science and how the low and the previous low and the high and the previous high and all this complicated stuff. I didn't want all of this. So I just went with the simple how far, high, low, and then run that as an average. And it worked so much better to me because it's not so convoluted, right? I have more confidence in something when I understand how it works. And to me, the ADR is much less complicated than this. So, yeah, ADR, average daily range. I hope he was on the stream with us. He was not. How do you like that? All right, so tomorrow we're going to get into scanners and setting up watch lists, that sort of stuff. Don't really have too many topics today, unless you guys got something that you want to hit on specifically. So I thought I would take a look around and maybe talk a little bit about drills too. Just mute things so I don't keep getting that alert. I posted a thread today. If you guys scroll back, the thread was about Fed liquidity and going forward, what our expectations could be or should be about the market. So that's a good one to kind of dig into if you have a chance later on. All right, chartered market technician, CTA. There's these groups of traders out there, right? So there's volatility control funds, there's CTA funds. Let's go to Grok so he can name all of the funds. Those are the two most popular ones. Um, or we'll use Gemini. Why not? So we got VC funds, CTA funds. Come on, get the E there. Yeah, I do. I mentioned CTAs in the morning because they are a big part of liquidity in the market. Every one of these different groups have their own niche area, and most of these are what we call non-discretionary traders, right? They don't get to perform a background or analysis and make a determination that, gosh, it'd be a good time to go long or short. They don't get to do that. They have these set of rules in place, and whenever the conditions for those rules are met, they have to buy in or sell out X amount of the portfolio. Now, the percentage of that exit or entry is something they keep in house, so we don't get to know, what the internals are. But Goldman Sachs, JP Morgan, and a couple of others have a newsletter that they send out, which I do not have access to, but their readers do. And they get this memo like once a week, once every other week, something like that. And it really lays out if SPY drops, 5%, the CTAs are going to buy this much or they're going to sell this much. And that's amazing, right? Because then you can really sort to gauge, how much of an impact a 3% move in SPY or a 5% move in SPY would give the broader market. The problem is these aren't the only things that move the market, right? Like dealer positioning in the options market. There's some people out there like Spot Gamma or Volland who believe that that is it. That's the whole kit and caboodle, and you don't need to worry about anything else because dealers are the whole show. But we know that that's not true. Sometimes it's the dollar and yields. Sometimes it's commodities. Sometimes it's equities. Look at Oracle today, knocked the market down, and that had nothing to do with the S&P and the options and the dealer positioning. Or what about Nvidia last year? In the last 2 years, how much Nvidia has carried the market, right? So it's not always just one thing. These different funds allow us to have insight into what kind of liquidity is coming into the market or what kind of liquidity is leaving the market. I like to keep track of them because if they're selling out and we're still rising, then we know that the moves that we're seeing are not going to be directly attributed to just CTA positioning. So we'll jump over here to Gamma Lab. Gamma Lab's got a really good CTA position. And then we'll look at Mentor Q because they've got really good CTA positioning. Mentor Q is also supposed to have the VC funds positioning. It's right here, the vol models. But every time I click on this, I don't get what I'm looking for. I get this, and I don't know. It's okay, but it's not VC funds, that's for sure. So these are more of their vol models. Like that's a vol model, that's a vol model. But here's their volatility control fund model, which is what said I was looking for. And this is not that's not what I want. We're not seeing their positioning, right? We're seeing realized vol and the vol ratio, and we're seeing the S&P. Where's their positioning like we were looking at CTA positioning? That's what I would want to see. So this this is okay. It's not it, right? That's not it. Now this CTA positioning. So when we go back and we read what Gemini said, CTA stands for commodity trading advisors, often managing a type of fund or strategy. VC, they screwed it up and said venture capital, but well, it's not a screw up. Acronyms, there's so many acronyms. VC funds are volatility control funds. So if you get into this sort of stuff, you're also going to want to start getting into the COT report. The COT report is the commitment of traders report, and it looks at all of these different groups and starts to put all the pieces together between, collectively, where are they at? Are they, net long, net short? And then where are they at now compared to where they were last week? Have they increased their net short? Have they decreased their net short? And that gives us a better picture of where money is going in the market as well. Right. So here's the S&P. We want to get a specific one. E-mini S&P right there. We want the COT report. Make sure just by looking at the tick that we have the right one. We can see it's $50. There's so many things that you can pick that you could pick the wrong one. And that's just the easiest way to make sure you're looking at the right one. The ES has a $50 point. We know that that's the right one. Oh, and they're working through a backlog. So whatever, we'll just ignore that. This is the different groups, right? Asset manager, institutional, leveraged funds, other reportables. And I've done videos on this. And then we look at what group we want to look at and what they are, net long, net short, and then where were they and what are they doing? Are they increasing or decreasing? This all ties back into the CTAs, which ties back into like the volatility control funds. And what's the, I don't even like calling it smart money. What's the money managers out there doing, increasing or decreasing? And thanks to places like Voland and not Voland, but Mentor Q and Gamma Labs, we can actually pick the group that we want. Whether we want to look at the Nasdaq, the S&P, oil, gold, silver, and see the positioning for those funds. As I've mentioned before, just think of it as a portfolio. They are flat if they're at zero, and they're long if they're above zero, they're short if they're below zero. If the line is going up, they're adding to their portfolio. And if the line is going down, then they're decreasing their position in their portfolio. That's a really good way to think of it. So I like to look at them every day, see what's going on. It doesn't change much on a day to day basis. And even the COT report is delayed by last week, right? They correlate the data on Tuesday, they publish it on Friday, and then they repeat the process over and over and over again. So when you get the report on Fridays, you're seeing data from the previous week that they packaged up over the weekend and correlated starting on Tuesday so that by Friday they've got a new package to send out to everybody. It's delayed data. But these firms and institutions are so heavily vested in the market that they can't exit a position in a single day. We don't have to worry about that. It'll take time for them to unwind. Even just looking at the CTA positioning, if we were to jump back over to that, I should just put them all on the same screen. We don't have to do that. Scroll down here. We want the size of just one of these. So asset managers, institutions, net short, 44 traders are net short, 168 are net long, and it decreased this week the longs decreased 10%, the shorts decreased 4%, and the spread, the distance between, the combined trade, they are still net short in total. Because look at their shorts versus their longs. Nope, they're still positive. All right, so here's the positive, but they decreased their total net position by 1,500. So the asset managers are still net long. They'll be short and long at the same time. And if they want to reduce their risk, they can, of course, exit some of their longs, but they can also increase some of their shorts if they want to decrease their long exposure. If they were to try to get out of all of this all at once, notice that it's not saying the size of their positions, it's just saying that there are this many positions. 1.1 million long positions, 221,000 short positions. Well, what's the size of even one of those positions, right? That's probably really big. So we don't know, exactly what their size is, but we know that there's a lot in here, right? The amount of open interest that the asset managers have in the ES long is 57% of the net open interest in the S&P. That's a lot. Oh, that's a lot. This is their bar graph, right? So we just want to keep our eye on it, see what it's doing. Is it trending higher? Is it trending lower? Are they getting out, adding in? That sort of thing. And usually there's somebody who gets that memo from Goldman or JP Morgan, whoever it is. They get it and they put it out on Twitter. I see it oftentimes put in here. This is Gamma Lab, and they have this little like news section on the side. And Gamma Lab will republish a Goldman Sachs article about CTA positioning and that sort of stuff, which is nice because then, you have some sort of expectation that if SPY goes up X amount or down X amount, what CTA is supposed to do. But it's not actionable to like go out and get a trade just because you hear CTA is buying or something like that, right? It just helps us better understand what our expectations are for the market and what money is expected to do. Helpful though, in my opinion, it is really helpful. The CTA positioning here, we can see the changes in the CTA positioning, or we can see the projections on CTA positioning, which is pretty cool. Here it is. Well, it's delta. It's not the same, but if SPY goes up X amount, this is the anticipated or expected change of CTA positioning over the next 20 days for an up scenario, that the amount that they're holding long will increase up to 5 over the next 20 days if the S&P continues to stay long. Of course, we can flip that out and look at the down scenario. Looks like a heavy liquidity dump at the start of it, and then it'll start to decrease as we continue to decline. So it's just projections. I like the numbers instead, because what are these on the side? 5 what? Minus 1 what? Is that 1,000,000, 100,000, one, I don't know. So I like it when it's actually written out and it's not these charts, but it's just nice to know that it's in there. Vol control positioning in the S&P, the VC funds. That's what I was hoping to find on the Mentor Q account. We can see that VC funds are net long. So volatility did not go high enough to shake these guys out. How high would it have to go? I mean, you know what I mean? Back in April, they were still long. You guys remember April? It was pretty ugly out there. They got down to 50, And then since April, they ran up to 250. But since the highs, they're still holding above 200. So even the VC funds aren't dumping. Should we be scared and nervous and looking for shorts? Why? They're not. Volatility has not gotten so scary that it shook these guys out. Maybe that says something. And then for the CTAs, I mean, they reduced their position size, sure, but they were running it really hot, right? Oh, they were extended this year, heavily allocated to the upside. Of course, they're going to unwind some just because of how hot they were running it. So it's all just a part of the daily snapshot. We want to look at these to make sure that we don't see big, massive change because it would stand out, right? If we come in and we see that it is radically different than the day before, oh, I mean, that would be a huge heads up, right? So I peek at it. I just want to see if there's anything that's like, oh, damn, because the oh, damn stuff is really easy to see. And if it's not that, don't stress on it. You got plenty of time to kind of absorb this over the years, and you'll get to the point where it's just normal. But until then, if it's not doing the oh damn, then you can focus on, are we above and below the zero? Are we trending lower, trending higher? Where did we come from? And where are we going? And you focus on it like that, it's helpful and it give you that insight that you're looking for. Oh damn. Oh man, IBKR just sucks so much. Anybody use IBKR here in the community? Someone sent me that and asked if you're options trading, preferably if you're using or if you want to trade income trades or covered calls, is there anything that you might add to this setup that would help you trade those covered calls better? I haven't logged on to IBKR in over 5 years. I don't remember how to even run it. I'd have to start from scratch. So, if one of you want to answer that, I'd love to hear it. That'd be fantastic. Yeah, I only used it because I have Canadian clients, and as options traders, they weren't able to translate what I was doing in the Thinkorswim onto their broker, and of course, I couldn't tell them how to do it unless I actually used the darn thing. So I got an account and I learned how to use it, and I helped them set up. But yeah, that it's been a few years. I don't remember. That's all right. If you're Canadian and it's all you have, well, then, I mean, it's what I told my clients. If that's all you got, you better get good at it. You know what I mean? Because that's what you got. You got to make it work. But I've heard in the last few years that Canadians really have a lot more choices than they used to have. So that is IBKR, Interactive Brokers. It is not good, right? You're not missing something if you're thinking, "Oh, wow, that looks great. I'm gonna go get me that." No, no, please don't. Do yourself a favor and avoid that. This is not good. No, 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 no. But you know what I mean? Like it's all they had, so they had to make it work. Compared to everything else that they used to have, it was fantastic. Compared to what we have in the US, it sucks. I can make a flotation device out of my pants so that if I ever had to abandon the rig and try to swim home, my pants could be used as an inflation device to keep me alive. Sounds pretty good because at least I wouldn't die. But I guarantee you there's better things to use for a flotation device than my pants, right? So IBKR probably pretty good compared to two cans and a string between them, but I bet we could find something better than that. Learn all kinds of things in survival classes, huh? We want to keep our eye on the 2 year, by the way. When it comes to the liquidity curve and the Fed's going to start buying back, the part of the curve that they can I don't want to use the word manipulate, but I don't have a better word to use, so I'm going to use it anyways. The only part of the curve they can really manipulate is the front end. So if they buy or sell on the front end, it will adjust the curve on the back end eventually, right? Yeah, no, TradeStation is better. I started an account at TradeStation and it felt like I was starting all over on Thinkorswim, with all the features and the settings, and it seemed like it could do everything that Thinkorswim does. It really did. But I didn't want to have to learn a whole new system from scratch. So I stopped and I didn't use it, but it looked really good and it seemed very intuitive. Like it really it seemed comfortable, and I bet it would be nothing if somebody was new to choose something like TradeStation and use it. I've heard really good things. And on our website at the Bullish Bears, we've got videos on it, and I think we got some blog posts written about it. So yeah, as far as I know, Canadians cannot use Hood or Weeble or Moo. Maybe Moo because it's from China, but Moo didn't exist 5 years ago. At least I hadn't heard of it at the time. So I don't know what they can use now. I was talking to a Canadian last week and he was like, dude, we got all kinds of choices. So I guess now they have a lot more choices than they had 5 years ago. But 5 years ago, all they had was IBKR or trash. So you really had to make do with IBKR. And Ninja. Ninja was the other side of that. I really like Moo. I do. My only gripe was that when I went to open an account, they denied me because the account is in mine and my wife's name. And they're like, this trading account is in your name. And you tried to link us to a bank account that's in two people's names. And this is denied. Well, that was frustrating. And then they sent me emails about some arbitration process or some reconciliation to get it all fixed. And I like, whatever. You done booted me. I'll get around to it maybe eventually. And I don't need to trade there, so I just never funded it. So I still have an account. It's just an unfunded account. I trade it Tasty. I'm very happy to trade it Tasty. So if I didn't have that, maybe I would be more interested in getting that funded, but I don't need it. I've got 27 funded accounts, 42 accounts total brokerages, 42 brokerages, and over 115 accounts on those brokerages. So I don't need another funded account. And I could be off by a number or two either way, right? I'm just kind of rounding a little bit, but that's close. I started with $300 and a Robinhood account. So, you know, if I can do it, anybody can do it. I like all those videos where they're like, there's, you know, oh, how do they say it? There's generational wealth and then there's just wealth. Yeah, well, it's not generational wealth, that's for sure. $300 can get you a long ways. That is true. Yeah. I remember 30 years ago, dishwashers in Las Vegas were making $25 an hour. And of course, that was a big deal back then. I bet they're making like $50 an hour now. But, the rents were outrageous, and even making $25 an hour 30 years ago, it was barely enough for them to scratch by. That was poverty level. So yeah, I guess it depends on where you live. But trading with $300, which is what I meant, 300 can get you a long ways. Trading with $300 can get you a long ways. It can be. This is stockcharts.com, but I don't trade on it. It links to the trader volatility website. And then with these guys, that links to the trading brokerage. I've got the brokerage, I've got an account there. I don't trade it, but let me sign in and it'll say what brokerage. None of those. I gotta change things. So every morning when I post the list that has equities with the call wall and the put wall, that comes from this, from trading volatility. So I put in the stock down below, and then it gives me the gamma levels for Thinkorswim and for TradingView, and then I share that with you guys every day. My watch list this week broke. I had a whole list, right? And I've been using it for months and months. And then one name on the list broke, and you never know what name broke. So I had to wipe the whole thing out, and I've been slowly repopulating it one name at a time to make sure it still works until I find the trouble name. I still haven't found the trouble name, so I don't know. The watch list, I'll post the names that I had. This is what names used to be in it, and one of those broke. It should get us to the broker here in a minute. Or another way to do it, I guess I should have just done it this way. When we're on stock charts, we can jump over to their ACP, and from here we can trade. So it should have popped up with, there it is, Tradier. There. It was right on the tip of my tongue, and I just couldn't remember what the hell it was called. Tradier Brokerage. And I do have an account there. It's just not funded. And you get free equity trades and unlimited options for 25 a month. I really would enjoy some trading games, right? Like Scrabble for traders or something. I don't know. You could do like Pictionary and what's that one where you got to mime things? I need a life. I really need a life. I ain't got one. So you can, the answer is yes, you can trade from here. But notice to get here, I kind of left stock charts. I mean, you can see it's still stock charts up there, but you had to click the button that said take me to their ACP, and then you kind of hop onto another platform. They've been slowly integrating the two over the years, but they're still, in my opinion, two separate entities. Still, to each their own. This is a fantastic site for swing trades and long term trades. If you're day trading, do not use this, right? Please, because this is just not going to help you at all. And I think it would handicap you seriously bad. But swing trades and long term trades, yeah, this would be a good site to use. I've been developing my ratio charts here because there's some that you can only get here. And I'm not quite done. Once I am done, I'm going to be running through the rotation with all of you guys on, each chart, why I use it, how we can use it, why we should use it. And of course, the whole list will be done at that point. So I'll be able to share the charts. They all have a particular type of setup for a particular reason. And that makes it nice too. Some are just generic like this. That's just the NASDAQ composite, but it's got the high yield index options down here. Remember, we were talking about that the other day, only it was all by itself. It's the ICE Bank of America index options credit spread, blah, blah, blah. The one that Kevin thought it was my password when I posted it in the chat. That's funny. I've used these guys for years, by the way. And then I let the subscription lapse and I go use something else and then I come back and then I leave and then I come back. They were my first go-to when I started as a trader. Hey Austin, always love it when you show up. Thanks for the questions. If you've got topics, I'm going to be streaming tomorrow. If you got something you want me to hit on, let me know. Yep, ADR, CTA positioning. Tomorrow, I'm going to hit scanners, trading view scanners. I thought that's what we had agreed was trading view scanners, right? Or was it supposed to be today? No, that was tomorrow, right? Yeah, okay. Ooh, all right. Yeah, yeah, yeah. I was just making sure. Like, shoot, was I supposed to do that today? Yeah, we'll get it tomorrow. I do like fib stuff. And you know what? I know Jeremy's really big on the fans. And to me, they're always really cool when he posts them, but I never use them. I've read a couple books on them. I dallied with it a little bit, but I never got to the point where I was comfortable with them. And so I just don't mess with them. And there's a lot of different fib things out there. Like there's this sequence counter. Let's bring this up. There's this one, these arcs, and then there's this one, the cycle brackets or a sequence counter is what I call it. The market does weird things, right? And it's stochastics in a lot of it. It's stochastics. But the less complicated that I could ever put it is that it's wave form. And wave form has done me really well over the years. That's a new one. That icon is new. Time extensions is not new, but they changed the icon on time extensions. You can see how this one runs left to right, just like it always has. It's just a new icon. It kind of surprised me there for a moment. This is another form of wave extension, by the way, or waves. So there is a lot of really cool stuff out there. And hopefully what I've demonstrated throughout your time here is that you can make anything work for you, and you can take the book and throw it right out the window. As long as you prove that what you're doing works and you can be consistent with it, then you can do whatever you want. When I started using fibs, there was a guy that was here at the time who used this fib. This is the one that you click 3 times, right? You come up, you come down, and then you run the next like that. And I know another trader who uses this same thing. I don't like it. I never had any reason to want to use it. But that doesn't mean there's something wrong with it, right? It just doesn't suit me. But with all these different tools, if you find a style that you can use it and it gives you actionable intelligence and you can prove that and stay consistent with it, why not use it? Right? Like, why not? Now, sure, I read all the fib books that I could get my hands on before I finally said screw the fib books and threw them in the trash. I at least read them, tried to understand where they were coming from, and tried to apply it the way that they taught it. I just didn't like what they were saying, especially when you get one guy who says, you got to do it my way or you're doing it wrong. And then you find another guy and he says, you got to do it my way or you're doing it wrong. And his way is not the same way as the other person's way. Right? And then you're like, well, you both can't be right. Then, very likely you're both wrong. I think what a lot of people get hung up on is what are we supposed to do when price gets there? To me, I think that's where the big hang up is. That's a really nice rising wedge, but it has rose too far and it should not have gotten that deep into the uh, wedge end, what I call the apex, even though I know that's not the proper word. It needs to be called something else. I just don't at the moment remember what that would be called. It should not be this deep, right? It should stop somewhere around 80% and the other 20 should remain empty. When it goes that deep, what I have found over the years is it doesn't perform the way we expect. What we expect is a rising wedge should break down because that's what it's supposed to do. And sometimes it'll blow off top and then it'll break down. And that's okay. But if it gets too deep into that last little bit, instead it'll often just break out. And that's a big fooled you, right? Ha ha, gotcha. That sucks. So at this point, I would be looking for a breakdown here. Probably get back to say 80 or 72. I like 72 a lot, but be careful of like a blow off top first because we still got 111 and 1236 from yesterday. There we go. And that's a really big 111. I mean, it doesn't seem like much, 7 points, but 7 points is a long ways. And for a blow off top, I would expect probably a little bit more than that. But we'll see what we get. Has a nice megaphone pattern the day before, kind of. Not great. So I've seen a lot of questions about fibs and a lot of discussions on them. Where I see a lot of people get hung up is they're not quite sure what they're supposed to do with it. Like getting them on there is one thing. Okay, we got them drawn. Now what? Right. So, if you start with just the idea that these fibs are supposed to help you better analyze what price is doing and what we could expect out of price, then that's a good start. Okay. So if we're holding 786 on a pullback, what are we supposed to do? Right? Like, okay, it came down, it got there. Is that a buy? Is that a sell? Well, the 786 held. So the expectation is that we're going back to 100. And if we can get above that, then the expectation is that we're going to go to 111. And above that, that we're going to go to 1236. And if we break 786, especially now that we've touched it, we're going to aim for 50. In none of that did it say, okay, get long, get short, because we'd want to see signals in the candles themselves showing us that the reversal is holding, that traders are coming in and buying it up. Maybe the pace of the tape increases or the VIX starts to fall a little faster. The candles get bigger, some sort of signal that is giving us greater confidence. I mean, sure, we don't need that. We can just pull the trigger because it got there. But if we can add more to it, then we've got a better idea of what's supposed to happen when it's going on. Once we get through the half, we're going to target the low end. But I'm not a buy and hold guy. I don't want to get in as we cross this half and hold it all the way down to here. I mean, I wouldn't mind the money if you're just giving it away, but I'm not interested in that kind of trade, right? Somebody else can do that. I'm sure if they want to, they would be all over it. Me, I would be more likely to get in, run some short, and then when price pulls back, maybe it tests underneath the 50 and it starts to fall, I get in again, and then, price in. That suits my style because we're still headed down here and we haven't reached that yet, and we haven't broke back above the half yet. So I'm still finding opportunity to trade to that zero line. Or the other way around, right? Price came up and finally got to the 100, pulls back to 786. Sure, 786 held. The expectation is we're going to the 1, and if above that, then the 11, the 236. But that doesn't mean that I think I'm going to just get in here and run it all the way to here and then some. I'm likely to get in, run it until it starts to look a little weak, hop back out, wait for some sort of a pullback to test again. Or if it doesn't and it just comes on up, then let it get through, get on the other side of it, see if it tests, find another long, right? Why? Because I still got forward targets. It's not turning around, it's still going in the same direction. The criteria hasn't been met yet. Let's, hop back in, get another bite of the apple. So I tend to use it that way. And as a place to anticipate where price should react, like yesterday's high. I love yesterday's high, yesterday's low. It's a price point that should react when we get there again. But just because we get there doesn't mean it's a trade by itself. If I was long and we got to that point, I would be looking for an exit because I shouldn't have any expectation that we're going to get above and beyond that. Once we do get above and beyond it, then I can, aim for 111, 1236. But I would wait for 1236 because I know how good the reversal is from 111 and 1236. I wouldn't try to trade into it. I'd be waiting for it to get there so I can trade against it. So with all of these pivots, whether it's fib levels, quadrants, yesterday's high and low, ADRs, you can trade to the levels, or you can let price get there and then have a game plan for what to do once it does get there. I found that to be really helpful because you got time to plan, right? We don't just show up at yesterday's high. We worked our way up there. So we had a couple of long opportunities and then it started to get really nasty. Maybe we had a couple more long opportunities and then finally we're like, well, we're just too close to the high. I'll sit out, let it get there, and then find an opportunity to do whatever it decides it wants. If it's going to break down, we got short trades ready to go. And if it's going to break out, we've got breakout trades ready to go. At that point, we can call timeout, check the tick, the AD, advanced decline, bonds, dollar, yields, whatever. We can take a look around and get ready and have a better idea of what do you think it's going to do? Break out or break down? Which, by the way, I think it's going to break down, but the AD says no, it's not. The ticks are getting weak, but the ticks haven't broke down yet. So this says it's possible we could break down, but it's not enough yet. The AD certainly says no, but AD is not a trigger, right? We're losing the Mag 7. We can definitely break down. And the banks are getting close to VWAP. If banks get under VWAP, look for Mag 7 to get to the VWAP. And then we can see the green line is still leading, but it's starting to roll over. We're flattening out here. We could totally go short this afternoon. Got 49 minutes, 48 minutes. We could get some lower targets. And then, bring in things like the CD. Oh, CD's bullish. Look at that. It says we ain't done yet. Long into 69.11, maybe 69.15. What do you think? Let's put this back where it goes. So we were there, then we were there, then we were there, and now we are there. All right. So that's where the fibs go. And the CD is breaking out to the upside, suggesting that the ES is going to get into 69.11 cog line. For me, the short is the more appropriate trade, and I wouldn't try to trade from 8 to 11. It's 2 points, right? 69.08 to 69.11, 3 points. I mean, it's just too narrow, especially if you want a good risk to reward. There's not enough room to meet that qualification. The better question is what happens after we get to 111? Are we going to keep it? We're going to pull back from there? If we keep it, then what's the next level? The next level is 69.20. Let's put yesterday's on here. Now we've got yesterday's 111, and that is where'd it go? 69.16. And today's CD is pointing to the upside. Look at that. It's not much. It's just a itty bitty little bit, but it's going. That's a scalper's delight. Yeah. Doesn't look very pretty though. Hey, we were talking drills last week, And since we don't really have any topics, let's hit on drills for a minute. To do that, I'm going to log into paper, and these are drills. So you're going to see me buying and selling, but I don't have any risk. I'm on paper, so don't copy what I'm doing. And it's a drill, not a trade. So we wouldn't even consider what I'm doing any bias towards being bullish or bearish or anything like that, because that's not the purpose of the trade. It's not the goal. All right. So I got videos on this topic on the Bullish Bears. So you can see demo, right? Demo. When you are working on drills, the idea is we want to work on a particular piece of the trade. The trade has a lot of parts. You got the entry, the defense, and then the exit. And I'm sure if we wanted to, we could break it down even more. But those are the three parts that I tend to focus on. So when I'm going to get into the trade, for an example, and I want to work on entries, I can't tell you how often I've seen that in the past where somebody says, "Man, I really need to work on my entries. I was too early, I was too late. I didn't get where I wanted it. It ran away before I could get in. I need more work on my entries." Okay, well, what are you doing to work on your entries? Right? One of the things about drills is you have to go to a smaller time frame because you need the opportunity to get in again and again and again and again and again. Remember, it's not about trades. So when I tell people you got to go to a smaller time frame, what I usually hear is, I don't want to trade on a smaller time frame. I don't want to trade a 30-second and a 1 minute. Well, cool, because I don't either. But we're not trading. We're doing drills. And then that's a big difference. So, for an example, we've talked about my swing low logic, how after a swing low and we're on our way back up, we should anticipate wicks on the bottom of those candles because that's what we get after a swing low and we're on our way up, wicks on the bottom of the candles. And if we had a swing high and we're going the other way, then we anticipate wicks on the top of the candles. So if we're working on entries, one of the things that we could try to work on is I want to better time my entries where I'm working with that wick logic. So we go to a smaller time frame so that we get the opportunity to do this again and again and again as often as possible. And then we only focus on getting that trade on. Well, we can do that by using the trade buttons, which I don't have it there. We could use the dome, right? Depending on your broker, there's probably a lot of ways to get that done. I'm just going to add the trade buttons, and I've got one click trading turned on. That way we can get in and out. No crazy alarm sounds because we just drive each other crazy with that. Should be good. So if I was working on a drill just for my entries and the entry that I wanted to work on was these wicks, now I'm ready to go. I've got a small time frame. I've got my condition to get in, the buttons or the dome. I'm ready. And the only focus would be, okay, let this candle close, the new one open. If I'm going to time a wick entry, I could be trying to time up here if I want to go short, or let this current candle close and maybe catch the wick off the yellow line down here and just be trying to work on this logic, right? Of course, you got to have a bias. Are we thinking it's going to go up? Are we thinking it's going to go down? And we don't have a swing low like we did back here or a swing high like we did up here. So we really don't have any reason to think that this is where we're going to get these wick trades. But if that's what we're focused on, then that's what we would be doing. We let the current candle close. We let the new one open. We anticipate the wick to be in the opposite direction that we want to go. And then we focus on trying to get that entry. But what if you're only focused on exits? Then you would jump into a trade as soon as you can and you would focus on whatever part of the exit that you're having troubles with. Are you walking your stop too close and kicking yourself out of the trade? Do you get scared easily and just abandon the whole thing before it has a chance to move? Are you a deer in a headlights who don't close the trade and just let price come all the way down and stop you out? What problem are you trying to solve? Then we start putting together some drills that help you solve the problem. I've used the analogy before of standing on the free throw line throwing basketballs. If you do that every day, throwing 500, 1,000 balls a day, you're going to get pretty good at throwing balls from the free throw. It doesn't mean you're going to be a good basketball player because you haven't done anything else that's going to improve you as a basketball player, but you'll be able to hit those free throw lines, hopefully, or at least the keys. So, doing trading drills won't suddenly make you a good trader, but they will help you focus on one particular part of the trade to start solving whatever it is that you think needs to be improved, or whatever problem you're trying to eliminate. When I first heard about drills, it was from Jigsaw. When you get a Jigsaw account, you get a couple of videos about trading drills. So of course that got me thinking, well, how many other drills are there? Because they offer three, which after I learned them, I made videos about them and put them on the Bullish Bears. But there had to be more than those three, right? So I started looking around, and there are companies who develop trade drills. That's what they sell as a product. They changed their menu system around. Now it looks more familiar. I think it's in the overview or it's in module one of these two. They start getting into cut and reverse, and can't remember what the other one is called. But yeah, this is the first spot to start getting into drills. But you don't need this, right? Like, I'm not trying to convince you to even try to do something like this. You don't need order flow tools like Bookmap or Jigsaw to do drills. All you need is candles to do drills. You can do that on your own broker. You don't even need to get into a trade. One of the drills that they have is it's a passive drill. You sit and watch. You don't actually push a button at all. You just sit there. Cut and reverse is a frustrating drill designed to teach you a lot about yourself, really. That's not what I was looking for. Go away. I think this trader's mastermind is doing the same three drills that are at Jigsaw, but there is a site. I'll have to find it again that had trading drills on it, and you could sign up and get like their emails. They'll send out. Oh, I don't want to call it advertising because it wasn't junk, but they were just little blog posts about drills. You didn't have to buy anything, but it wasn't this. That's something else. I don't know what that is. So drills are not a new concept. That's the main thing. I didn't invent them. They've been around for a long time, and they're not trades. And you can work on them to do all kinds of things. Say you want a tighter stop. I designed the two for drill for my coaching clients that focused on this, especially if you trade the NASDAQ. It's a NASDAQ drill designed to help you use smaller stops. And it's crazy frustrating, but it can really help you with the size of your stop. And that's the whole idea, right? Be able to trade with a smaller stop on the NASDAQ. I'm not going to go through the whole thing, but the idea is set a bracket order that has a 1 tick or a 2 tick stop, and you get into a very small time frame like this, and you just try to get in over and over again, timing your trade with everything that you have, order flow, the tape, time and sales, cumulative delta, whatever, and not get stopped out. Now, it's not a trade, so you get in, and if price doesn't immediately stop you out and it starts moving up, then after 4 ticks or whatever, you just kill the trade before that bar ends, preferably, and then you get ready to do it again with the next bar and the next one and the next one, as long as you see the opportunity to get the trade, right? And it'll teach you to kind of time your trade to work with price rather than against price, so that you're not getting wicked out and then seeing price move the way you wanted to go while you're stopped out and not in the trade. It's a good drill, but it is crazy frustrating to do the drill. And we wouldn't want to actually use a 2 tick stop once we're trading. That is not the ultimate goal. It's just to get better at timing your entries so that you can use a more reasonable stop. I use a 2-point stop on the NASDAQ, and I find that to be more than enough. And I don't normally take a full point, a full stop loss. When I'm wrong, I can usually get out before it hits the stop. But you see how sleepy and slow we are? It's not moving all that much. If it was a really wild day, the NASDAQ, I mean, this thing would gap 2 points, right? I'd be stopped out even before I noticed the price had even moved, just by how much this thing jumps. Hey, we're finally breaking down. If we're doing it here, we're likely going to do it on the ES. Be careful that this isn't going to turn into a raid and then a run, because we had the draw, and this could be a raid draw scenario. You could snap a micro here and look for the reversal. I don't think it's going to reverse. I was just giving the warning, like, be careful, because we didn't have the tick. We didn't have the weighted AD. This could be the fake. Oh, yeah, we're getting a little bit of ticks. But look at that weighted AD. And it's so late in the day, the weighted AD isn't going to get down to minus to 250. Going long when we're above 250 is going against the trend. But all trends have to start their turn at some point to go the other way, right? All trends have to start that turn at some point. So the tools that are measuring that trend are still going to say, hey, you're going the wrong way, don't short it. But that tool is a bigger perspective tool than one single bar. It's a good start. 68.92 cog line coming into focus. If we get under 92, we run for 80. So these average daily ranges, if we get to one side early enough in the day, we say that it's possible to go to the other side by the end of the day. And I mentioned that this morning in the morning briefing because we had got to one side early enough in the day. Now the ES hasn't made it back up all the way yet, but it's moving in the right direction, right? It's getting there. The logic for that was not bullish or bearish. It's just price as it makes that wave, right? That stochastics that we were talking about. It could have been going the other way, doing the same thing, just making the wave. So we anticipate that if we already hit one side, it's time to turn and go to the other side of the wave. That doesn't make it bullish or bearish. There's a couple of things with those ADRs too. When we got completely underneath this thing, it started to act as a resistance so that if we wanted to get back through it, it was going to be very difficult to do. But if we do get through it, that gives us a lot more confidence in the long because we know that they were bullish enough to break back through the lower ADR. Or if this was at the highs and we were trying to fall, that they were bearish enough to break through that level. So it adds more confidence into the idea of, well, where are we headed? Probably to the upside because we managed to get through that. And then, of course, old resistance becomes new support. That's Busby. This is not a good Busby for an example of a Busby, but that phrase, old resistance becomes new support, that's Busby. If we get through the ADR half and we continue to go, then we already know where we're headed. We're going to the other ADR line. If you look at the ADR, it's 1.29, right? This 89 points or 1.29%. So from where we opened last night, if we moved the full ADR in a single direction, we would go all the way to the yellow line. That would be 89 points, or all the way up to this yellow line, and that would be 89 points. But the distance between the two red lines is also 89 points because what price usually does is it just forms that wave from one side to the other side. That's the average daily range. And then we know it's moving outside of its norm if it gets beyond the yellow and it continues to go in the same direction. We would know that, hey, this thing's moving way beyond what it normally should move today. And that gives us a clue as to how strong it is. Like, why it's got to have a lot of strength to make its ADR and continue to go. It'd be very bullish or very bearish. I think Costco's got earnings, what, tonight, tomorrow? It's really close. Tonight. I was talking to somebody who wanted to get into premium trading uh, earlier today, and they were asking questions about getting that done. You could see that they had never been in a community like this because they only had the YouTube guru answers for premium trading ideas. If you haven't done it, the idea would be that you can sell options and collect an income from just doing that. They're high probability trades, they don't have, fantastic wow profits, but they are consistent profits. And with the high win rate, they just do their thing. Um, if you've been around, you've heard me talk about high probability. The handicap to a high probability trade is that they don't pay as much. Why would they? Your chances of winning are really high. So you're not going to make a lot of money. And if you're wrong, you're going to pay for it. So high probability are not necessarily the golden child that it sounds like, but there is a system to premium trading, and the industry standard is more of like a covered call or a covered cash secured put. But what if you're using an account that can't own the stock? Well, then we run like a diagonal play. You buy a call farther out in time, and then you use the short call, and you're nimble. And you sell it, buy it back, sell it, buy it back. That system works out pretty good if you can do technical analysis to decide when it's time to open a trade by selling the call. And he was focused on something that was going to have earnings, which was to me a really bad idea. But it had a lot of IV because it was going to have earnings. And that's what got him focused on it. Premium traders generally look for things that have a high IV so that when they sell it to open, they get more juice. But that's a bad way to go. If it's got more juice, it's likely to make bigger moves, and that means it's more likely to hit you. Costco is going to report earnings today. We can look at the last couple of years, and I like to scrunch this thing up so that I can read all the labels kind of side by side like this rather than in a long line. We got 20 quarters analyzed. It beat 15 times, missed 5. Okay, that's a good start. I know, right? Hey, I bet they announce it before the next earnings. I bet you Mountain Dew. The 21-day pre-earnings ramp is a negative quarter of a percent, so about $2.50 to the downside. The 8-day ramp into earnings is around 1.25%, so about an $11 move to the downside. So what do we know about Costco from that? It normally sells off into earnings and then it beats on its earnings. That's the typical Costco move. Now, after the report, it generally also goes down another half of a percent. So another three and a half, almost $4. Well, that's good to know. Even after it beats, more often than not, it still goes down. Now, in the next 8 days after it reports, in the 20 earnings that we're analyzing, 6 of those earnings, we never moved 5%. 6 times. We didn't even make a 5% move to the upside, but we were positive. And 2 of those times we did make moves bigger than 5%. So out of 15 beats, 20 earnings, only 8 times did Costco go up after it reported. And only 2 of those times did it go up more than 5% in those 8 days. 11 out of 20, so more than 50% of the time, it went down. And 8 of those 20, it went down less than 5%. 3, it went up, went down more than 5%. So this thing's got a history of selling off. no matter what its earnings. And if we look at the IV, we're kind of low compared to what the average IV would be. Maybe. Let's see. This one was higher. That one was only a little bit higher, but higher. So was this one. That was lower, higher, higher. Yeah, we're lower than the average. Back in 2021, during the whole face ripper into the 2022 bear market, this actually had a really low IV for its earnings. Then we got into the 2022 market, and the whole world was bearish, and IV went up kind of high. All things considered, IV is still pretty low. Big gaps down on its earnings. Look at all these red tags. Big gaps down. 3%, 1%. I guess 1 isn't very much. Here's another 3% move. That's a gut punch. 3% to the downside. That looks like positive earnings too. It is positive earnings. Why'd it go down if it was good? Forward guidance, probably. So if I was looking for a trade on Costco for earnings, one, the best earnings trade I've ever come up with is to let it report, to hear what they have to say and decide that's bullish or bearish, and then play something like a red to green after the earnings. So, it would report today. Tomorrow, we would look for like a red to green to go opposite of whatever they said. So, if the market was like crazy bearish, it gaps down, we start to turn green tomorrow, and the market just buys into it and gets it ripping. That's a beautiful long trade. Usually get a nice swing out of it, or vice versa. If we got bullish, and then the next day we turn from green to red and the market just starts to hammer it anyways, that'd be a nice swing. So those are usually the best earnings trades for me. But you can also run the anticipated range. I know it's really popular to play the big move, but a lot of companies, after they report, they gyrate around and they end up just ending up right back where they started. Here's a really good example of that. It reported and it made a really big move, and then it just gave over half of it back. So if we were playing that over a 2-week period and we ran something like, oh, I don't know, a butterfly based on where it closed on that earnings day, we would have been really profitable. And that's a decent trade because butterflies are crazy cheap, doesn't cost much. And it's just putting on a bet that says, after it's all said and done, I bet you just come right back to where you started. We did the same thing here. We had earnings, it got all wild and came right back down. And then it overshot and came right back up. Same spot. Same thing here. Earnings bled off, gapped above, and still circled around and came right back down and tagged that gap. Then it got wild and still came right back down, tagged that gap. What'll it cost for a 2-week butterfly? What are we looking at? 875. This thing really needs a stock split. 885, I guess, what we're closer to. 885. Let's try 890. Well, we'll do 885, I suppose. $13. And it's $5 wide, so you're risking $15 for a chance to make $485. Well, that's not bad. We go out 15 days, and it's $25. And if we was working the order and we had time to, sit in there and really hammer it out, we could probably get it cheaper, especially if we had done it earlier in the day. But it's a pretty simple trade, all things considered, right? And this is an expensive stock, so if we were doing it on something cheaper, it'd be a lot better. That spot gamma level has been just a dog this week. 6906. That short's working out pretty good. There's some issues happening right now I'm not real excited about, but in my charts, growth versus values breaking down, this IWF IWD ratio chart is my tell for Mag 7 stuff. And this needs to get back above 230 if we want to get long in things like Apple, Microsoft, Google, Nvidia, those guys, right? The Mag 7. We don't want to try getting into the Mag 7 when this thing is bleeding off. But look at the Mag 7 MACD down here, right? Or the stochastics. But I mean, I could turn the MACD on. It would be kind of the same thing. This thing is divergent. It's headed to the upside, and this is headed to the downside. That's no good. So that's some big discrepancy there. On the weekly, they're aligned and it's pointing down. This is saying don't get into the Mag 7 right now. This is not a buy the dip opportunity. Of course, we could be wrong and we miss the buy the dip, but at least we won't get hurt, right? Because we can take the risk if we want to take the risk and do it anyways, if we saw a long setup. But this is saying don't even try to take the setup. It's a bad idea. Yeah, it's a stochastics. I thought it was. So longs are a bad idea in the Mag 7. But this consumer discretionary, this is a flight to safety signal. If it's going down, then getting out of the market and or shorting the market would be a good idea. Maybe focus on like staples, soup and cola, toilet paper, staples, that sort of stuff. It's not telling us to do that. It's not, coming down like it was doing here. It's more flat than anything else. So, sure, don't get long the Mag 7, but don't try to short the market. Now, this has me scratching my head, and I still don't know what to do with it yet. This is my own little homemade tool, and it's new because the Mag 7 is new, and so is Top T. Both of those ETFs, they're not old school legacy products like XLY and XLP. These haven't been around forever. But what we're doing here is we're comparing the Mag 7 against the top 20 names in the market. And we know the market is generally run by the big dogs, right? Like the Mag 7 is dominant, and the other 493 could just take a nap and the Mag 7 would carry the day. But what if the Mag 7 isn't carrying the day and we're still not selling off, which is what we have happening right now? The Mag 7 is not outperforming the broader market. The broader market is outperforming the Mag 7, and it is happening with the top 20 names outperforming the Mag 7. These tools we're going to expect to stay broken for a little while because they are connected to the dollar and yields, and we know the government is going to be buying up the front end. So this is muddy water at best. But if they weren't doing that buying, this is crazy bullish. Look at the violence of this move. US 30, JP 30. It's a great tell. You can see the blue line is the same as this one and the same as this one. Orange is the S&P, and this sort of I don't know, cyan, that's the Qs. They match, right? When the blue line goes down, so does the S&P, so do the Qs. So when this line is going up, we expect the Qs and the S&P to go up. But look, they're not going up. The Qs are sideways, and the S&P, okay, it's pointed to the upside, but not as strongly as the blue line is pointed to the upside. The rate of change in the S&P is not matching that blue line. And recently, we've had divergences. If we just look right there, the blue line went up, cyan line went down, so the Qs actually went down, and the S&P, it did go up, but not as much. Same situation as we had today. And what did the broader market do? It fell the hell out of bed. That's why the very next day we dumped, even though that blue line was going up and the S&P was trying to go up. Everything fell the next day. Everything fell. So it's no bueno, right? It's no good. I don't like this warning. This really kind of implies that we could get this sharp rollover tomorrow, like getting out of risk before the weekend kind of thing. All right, this is a tech picture. It's generic tech, not like the Mag 7 tech. It's on a monthly. It always stays on a monthly for me. And we don't have any good information here. We're inside of last month's bar, and that's worthless. If we were breaking out or breaking down, then we would have more information, but we're not breaking out or breaking down. Tighten that up a little bit. So until we get outside of this half, either we break back above the half and then we could, try to get a run to the top, or we stay underneath the half and we work our way down and break out of the bottom. We got to do something. The fact that we were above the half and came back down, I don't like that one bit. It's not good. So this is just a tell on tech. We're holding the line because we're not breaking down, but we're not advancing in tech. And that's clear. We're definitely not advancing, or we would be back above the half. Now, this is liquidity. Net buying versus net selling. If we were going down, it would be net selling. And if we're going up, then it's net buying. We can see the NASDAQ in the candles sold off and rallied back up. And now it's trying to sell off a little bit again. But net volume stayed long. Even on the sell off, it only got a little weak. It didn't dump. And as soon as the candle started to move up, this really moved up. New highs, breakouts, blue skies, and it's still sitting way up here. So if we were selling off, it's not happening under the surface behind the scenes. Tech is still holding up, just not the Mag 7. They're weak. They're underperforming. This is that Bank of America liquidity tail. If there's liquidity issues, this will go up. And sure, we're turning here a little bit and it's kind of pointed up, but we're at very, very low levels. And we know that because if we zoom out, this was April of this year when the S&P was down in the dumps and we're all the way down here. So yeah, it's pointed up just a wee little bit, but compared to this, it's nothing, right? So there's no liquidity risk yet. This is the bond volatility indicator. Think of VIX for the bonds, and it's low. So no issue with volatility in the bond market. This is the Mag 7, the homemade ETF version. I really don't use this anymore. I just use the mags, but I do keep it around because I know that people do use it still, and it's still holding up. We're on the daily on the left and the weekly on the right. Sure, we're pointing down a little, but look at the channel. The channel is very secure and there's nothing wrong here. Even the stochastics down here. Yeah, we got down below 80, but it's a really tight coil and there's nothing wrong with this yet. In fact, it's starting to curve. Look at that. It's curling back up again. So this is telling us don't short the Mag 7 just because they're underperforming doesn't mean they're a short. It just means that the broader market can't rely on them for a rally. We're going to have to rally for some other reason. The cost of puts are holding the line. Looks like they want to start to go up. That's what this blue line is here. How much do puts cost? The cost of puts will get more expensive if traders start buying a lot more of them, right? Supply and demand. So if everybody wants to buy a put and the puts start to get more expensive, this line will go up. So the VIX is going down. That's what the purple line is showing us. But the cost of those puts are not falling with it. People are buying puts. They're a little nervous. It's not getting out of control yet. If they really start buying puts, this thing will go up. But they're buying puts, or at least the cost of those puts are holding, even if the VIX is falling. Dispersion. This gets a little complicated, but you got the idea of correlation, right? That think of synchronized swimming or matching. If you want to correlate with your buddies, you want to sync up. The market will sync up more strongly when we're in a down move. The analogy that I could give to that is think about when it's a bullish day. How often do you see, quote, everything bullish, right? Usually it's a sector or a couple of sectors, maybe the tech sector and consumer discretionary, chips, something like that. But when it's a down day and everybody's hating on the market, man, every sector's down, right? All the stocks are down. Sure, we can always find a long hiding somewhere, but generally speaking, when it's a negative day, all the sectors go down. High correlation in negativity is basically what that comes down to. So when we look back at say April, when the S&P and the Nasdaq were negative and the whole everybody was hating the market, we were in a highly correlated market environment because everything was negative. When this is pointing down, it says that correlations are strong, or correlations are weakening. Correlations are strong when it's high, it's weakening when it's coming down. It's easier to be a stock picker when all stocks are doing the same thing. It's like throwing darts at a barn. You can't miss the barn. So, in a low correlation environment, you want to lean more on the indexes or run some sort of dispersion trade and run less on a correlated market condition. But if everything's falling, then I mean, it's a good time to play stocks because everything you trade is going to be doing the same thing, going down. So we're losing our dispersion or we're losing our correlation. You can see it either way because dispersion is in purple, correlation is in blue. It's going down. This kind of gets into bonds, but bullish above, bearish below. You can see we don't generally hang out too much above and below. We don't stay for long, I guess would be another way to say it. And then we're back to Japan and its situation. The JGB and the 10-year bonds were finally starting to roll over. We didn't get to 2 yet, but I would say the threat is not done yet. For all we know, this is just pulling back to get some wind and that it's going to give it another go. And this is a threat to global liquidity crisis, like an 07, 08 sort of financial crisis, because we just don't know how much this carry trade unwind could break everything. The system's been in place for, a decade or more. There can be unknown consequences that we can't even imagine yet, which is how things break, right? So that's what I got for you guys. Tomorrow we're gonna run scanners, and of course, if you guys got topics you want to hit on, we can do that. But we're going to be focused on using TradingView and running scanners and putting together watch lists. My market outlook says we're still not looking for shorts. We're not looking for the market to crash and burn, but the Mag 7 is not dominant and is not the reason that we're holding the line or going up, long and the short of it. If you guys got topics, of course, you could throw them in the chat, send me a DM, however you want to do it. Uh, Everybody that works here loves getting topic requests. So if you don't want it for me, ask Kevin. Even Marziti, he's been really gracious with his time. He's done videos and webinars. And if you guys don't have any questions, I'd say let's wrap it up and call it a day. Appreciate that. Everybody, have a good one. See you at the morning briefing.